This is the Commercial Real Estate Podcast powered by First National. He's Adam. I am Aaron. Our guest today is Graham Gooch, who's the president of Ayrshire. Welcome, Graham. Thanks for joining us.
Thank you very much, guys. Awesome to be here.
And welcome to Toronto, of course.
Yes, nice. Always good to be back.
Did you learn anything at Real Capital?
Actually, Rob Coomer, KingSet sponsor, said now's the time to be in the ground. And we kind of endorse that because we've got a lot of projects that are eminently starting construction with respect to multifamily out principally in Alberta, but also looking broadly in Western Canada. So, yeah.
It's always nice when someone else is reiterating the same vibe you've got.
Good endorsement.
Yeah.
And we did record with Rob earlier today. So if you want to hear a longer version of that answer, there's that episode
it was very good.
too.
Yeah, it was good. A lot of optimism. First, before we get on to some of the other topics and what you do at Ayrshire, why don't you just talk about your history, how you got into real estate, where you are today?
Yeah, appreciate that. Yeah, so I started my career actually at GWL Realty Advisors after graduating finance at U of A and worked on behalf of some Canadian pension funds, GWL's balance sheet, some separate accounts, and multi-asset class, primarily BCIMC, and then along the way became very entrepreneurially minded, left to study abroad at London Business School and Hong Kong UST jointly with their MBA program, and I ended up staying in London for 2 or 3 years and worked at a hedge fund that traded REITs, the largest REIT-focused hedge fund globally. It was tough picking stocks, much more like bricks and mortar type of guy. So really good experience. You feel like you kind of make the NHL and then you decide not to go in Mayfair. But I came back to work with the executive chairman of Ayrshire, who and that was 10 years ago now, and his name's Phil Swift. He had a family office at the time. It's now transitioned into more of a traditional investment management platform with third-party capital, but Phil's a really interesting guy, and he's got an impact thesis in deploying capital where we want to have, decent economic returns alongside social and environmental outcomes. And there's a lot of ways to do that. Multifamily purpose-built rental is a great spot to be able to, impact your community while still making a decent return. So we started doing that I joined Ayrshire in 2015, and it was at that time 100% Phil's capital. And now we've really grown the team and the mandate to have syndicate of primarily ultra high net worth partners to develop this housing impact fund thesis.
If we can go backwards for 1 second, when you were at Mayfair, there's a global REITs you were looking at.
Yeah.
How did Canada stack up against other global opportunities in the REIT sector?
So this would have been like post GFC, 2010, 2013. It was actually positive. I mean, the political framework and the population growth, the GDP per capita, more importantly, was a lot better then than it is now. I think somebody said that Canada's GDP per capita is similar to like Alabama right now. So I think we've come backwards from that perspective. But it was a unique role because you'd look at the MSCI index and you say, okay, like the index has like whatever 8% of its exposure to South Africa. And then we as a hedge fund would have to determine, okay, do we want to be over or under allocated the MSCI index to South Africa? And, I'm like an intern coming out of grad school and thinking like, well, I don't know what the heck is going on in Africa. Like, and you're on the conference call with like New York and Hong Kong and London. And it's like, yeah, Graham, so tell us about South Africa. And I was like, nah, I can't do this. I can't do this. I can bullshit like for, a good couple minutes, but like to do that every day, it's too challenging.
And what's the Ayrshire? So, I mean, you obviously, how did you know those guys? How did you get connected? And maybe what's their story? What's the background?
Yeah. So, why don't I start there? So Phil Swift started an oil and gas private equity firm called ARC Financial, ARC Financial, in the late 80s, backed by the Desmarais family. And it was a long bull run, as you can imagine, in the energy space. ARC, over its lifetime, I think has deployed over $20 billion in capital into, the energy space between its resources business and also its private equity funds. So along the way, like in the late 90s, Phil being executive chairman of ARC, had, quite a bit of success, quite a bit of liquidity. And he jokes he was like a Texas hedge in that he needed to diversify out of energy. So he decided to buy, commercial real estate and do it passively through other managers. And he jokes that it was a Texas hedge because it was highly correlated to energy.
Particularly if you're buying in Alberta.
Yeah. So he learned the hard way that way. But what ended up happening is he realized he wasn't a very good passive investor. He's much more active in nature. And so he wanted to build a team around that active mandate to invest private high net worth capital into, real estate. We were asset class agnostic for many years. To the point where we were looking at, agriculture deals in like Bolivia and like cocoa plantations in South America.
Just yield hunting wherever you could.
Data centers and storage. And I mean,
Adam is our expert of data centers at First National.
It's not a big step forward to be that expert. But
he's the only salesperson that's ever done a single deal on data centers.
Oh, nice. Yeah. Take some notes.
Yeah. Yield hunting. Keep going.
Yeah, well, it was interesting to be asset class agnostic, but it was also frustrating because you can't be really good at everything, right? So about 7 years ago, we decided to really vertically integrate into multifamily. And so we built a construction business around that, and we acquired a steel business around that. And so we try to deliver value to our unit holders by delivering a really attractive cost basis, which can, in a perfect world, expand your development margin and really, translate to decent returns on a risk-adjusted basis. We think multifamily rentals like the best right now relative to the 4 food groups: office, industrial, retail, res. Office is very scary. I mean, there's circumstantial opportunities that we would deploy money into. Retail is pretty expensive. Industrial is pretty expensive. But multifamily, when you've got different pools of capital supporting a thesis, the risk profile goes quite down. Lower credit from CMHC. We got grant pools. In some cases, we've got unique partners that are rolling in land positions, and it's an asset class that's very fragmented. I think I heard today that only like 3% of the rental stock in Canada is held by the REITs. Most of it's like
major private owner,
private capital, very fragmented. So it's a huge opportunity.
So talk about your 100% private at the time. You've been in now. You made a pivot towards multifamily.
Yeah, what year was that?
Yeah.
2000 pre-COVID, so like 2018, 19.
And then there was obviously a diversification of capital, and you started to go fundraise. Maybe talk about that, and then let's lead into the impact thesis
and acquiring a steel business for the purpose of rental. It's not the normal path, I don't think. Yeah. Or you're intimidating listeners now who want to get into this space. They might need to acquire one. So if you can address that too, that's a.
What are you buying next?
Yeah. Well, so Ayrshire has kind of 3 silos of businesses. The development arm principally focused on multifamily, IPP, which is income producing properties that we own and manage, and then operating companies, which would be the steel, company, and and the steel and the construction business. And so we do it as a means to an end in order to, deliver higher development margins on the projects. But like fundraising was a bit unique in our case because we were kind of backstopping it as a family office. Like we decided that we wanted to get into multifamily rental. Actually, because we had sites where we could subdivide land, we had retail positions with excess land density, and so we're like, let's just subdivide it, get it zoned, and those projects were phenomenally successful because we were able to achieve a lot of community outcomes working with nonprofit partners and a phenomenal economic return, and so that felt really good. So then we just backstopped. That was Housing Impact Fund number 1. And Housing Impact Fund number 2 was closed last year, and it was backstopped by some of our partners at the firm. And so it's a lot easier going out raising money when you say, hey, we're going to do this anyways. If you guys want to come along, great. To the credit of the team, like we got a really strong bench and a good track record to, attract private capital into the thesis. And we'll be able to be fully deployed on Housing Impact Fund number 2 by the summer here, fully called. It'll do about $500 million of multifamily.
What's the size of the fund?
The size of the fund with co-investment is about $60 million.
Okay.
So as you know, these projects are highly levered. We tried to get to 85% financing, and it's attractive financing, 50-year AMs, lower interest rates, and on that basis, with $60 million, you can build $500 million of real estate pretty easily.
Are you underwriting any of the recent changes at CMHC into your strategy?
Yes.
What do you mean, Adam?
Well, Aaron and I did do a lending episode just recently on this topic, but the quick and dirty of it, there's I guess a bit of a pullback on some of the risk factors on CMHC structured construction loans, and so you mentioned specifically financing being a key pillar for why this makes sense. Yeah. If the loans are on the more conservative side, does that pillar weaken to a point where maybe projects aren't viable?
They're making it harder for private developers to qualify. We were fortunate to be qualified to use the rental construction financing. It's now, I think,
ACLP.
ACLP, yeah. But back in the day, we called it rental construction financing.
Is that partly because of just the partnerships with the nonprofits you've got?
Well, that one actually, it was just for profit. It was only our capital that was developing, and we were able to, at the time, it was like, I think 98 basis point loan, 10-year fixed financing, 50-year amortization.
Is that low?
Yeah.
And so those days are long gone, and now you'd be in the threes, obviously. But
Ouch. Yeah.
yeah,
Still very good.
I think the numbers go around. I think the numbers go around better in Alberta than they would in other markets right now. At least you guys are closer to it nationally, but certainly the numbers in Alberta are good because our land basis is really low. We don't have very many levies or municipal charges, and our vertically integrated construction can solve that gap with respect to the margins. We think rents in Alberta are pretty low too, and not that we're counting on them doubling again or anything, but it's those factors combined. We're able to still rationalize the CMHC MLI financing even with the rental achievement economics.
I want to focus on I want to get back to market, and that's an interesting conversation because I agree that there's a lot of unique differentiators between what you're seeing in your market versus the rest of the country, but just double down on the impact thesis and just some of the strategies you've got as you've described it to us a little bit here, but pre-recording. What I took out of it was, it sounds like you're just willing to take on more brain damage than others.
Yeah, I appreciate you saying that. Yeah, it's tougher to take a bunch of stakeholders into one project. I mean, we've got one project in Edmonton where I think there's 5 different grant providers, loan forgiveness pools, and they're all stacked. And in order to get those approvals,
5? From who? Who are the people that are offering these grants?
AHIP.
He doesn't want to give his 6 secrets around. I'm not telling you.
Green
Those are
Municipal
my
Bond.
grants, not yours.
Well, actually, I'll give a shout out to one of our partners in Edmonton. They're the municipally owned nonprofit called HomeEd. And they've got a large housing wait list, and they want to build their portfolio for long-term, rental. And they needed a private capital partner to help build some townhomes. And so there's been a lot of pioneering with respect to structuring private capital with public partners. And there's other groups, nationally that are doing it. And I think one of the things Ayrshire wants to do is raise awareness about some of the structuring that we're doing, because if you've got pools of private capital, I mean, ideally, we're not owning these developments for 50 years. We want to recycle the money. And so we said that to home and said, look, in a perfect world, can you buy us out once the project's stabilized? And they want us involved because we can deliver, attractive value in the form of the costing and the oversight. And they've got the wait list of housing and all the ability to get the grant pools. And so it's a really good marriage of a bunch of different stakeholders that we'll probably write a case study on.
You didn't want to recycle through debt?
What's that?
You don't want to recycle capital through debt?
The refinancing? Yeah. Is that a plug for later? We can do some refinancings together.
Exactly.
Yeah. Well, it's tough when you're borrowing that much to begin with. You got to really count on some serious appraisal gains. But, HomeEd's got the balance sheet to backstop the purchase of our units once the project is stabilized. And so from our perspective, the private capital, it's basically an infrastructure play. Housing is becoming a lot more like infrastructure in the sense that you've got a municipally backed balance sheet that is guaranteed a minimum return for the private capital in exchange for partnering on a development. And with that project, we got $3 million of land thrown in for $200,000 from Canada Lands. And we've got all the grant pools. And so you can really start to take all these ingredients to contribute solutions to Canada's housing crisis. And I think a lot of developers try to do it themselves. They don't look for partners because, to your point, it's harder.
Well, that's where I was going to go, and I don't mean this to be negative, to the partners that you're working with, but it's just because of the just who they are and where their money's coming from, and the sort of the restrictions that they've got, and I'm assuming that just the decision making and the policies around it, it can be very, very complicated to get everybody aligned and pushing in the same direction. And I think we've had this conversation with many other developers who want to do it, have tried to do it, and then have said, you know what, that was just too painful, too much work. Nothing against anybody that was involved. It just the reality of the world that those people operate in makes it very, very complicated.
I think it's important to say, as much as you got so many people social washing and greenwashing these days, and we're so cognizant of that and want to be authentic to what we're doing and not doing. Like, the first and foremost priority is to make an economic return. I mean, we're not shy about that. It's like, in order to even come close to solving Canada's housing crisis, you need to mobilize private capital. The public capital can't do it on their own. And if private capital, in order to get it out of bed, you need to provide decent returns. And so we're not trying to do it all. Like, we're trying to be very careful and pointed with respect to our outcomes. I mean, one project in Calgary, we're working with a nonprofit that'll head lease 10% of the units. And a lot of developers do that now, which is a good outcome. They used to just lower the rents to qualify for CMHC, and the first people that showed up got those cheap units. And now what a lot of developers are doing is partnering with nonprofits who need those units for their housing wait lists. The nuance, I think, with that project in particular, what we're doing is like, discounting what would otherwise be $2,200 rents to $1,700 rents to qualify for CMHC, and providing those to the nonprofit. But then also introducing a philanthropic capital stack that'll donate money to the nonprofit so that it can deliver those units for $700 and go from 17 to 700. And so, working in the capital stack with different pools of capital. You've got some foundations in this country that need, a 6 or 8% return. So, well, let's do that as pref equity first. And you've got some foundations that have philanthropic money, don't need any return. So let's incorporate that money too, and try to come up with, a capital stack that can really be attractive for each of those stakeholders. And on that basis, it kind of becomes a little bit easier to swallow when you've got, different capital providers in the deal structure. But it takes time to get the projects queued up and structured and permitted. And so we've been able to do that with this Housing Impact Fund to the point where we're able to start construction. And if people know the project's real and you've got the financing queued up and the cranes are on site, and it's a lot easier to have those discussions.
Yeah, $700 a month is actual true deep affordable, which is one of the areas of affordability that's toughest to address.
Yeah, it's interesting. People use the word affordable very loosely, right? And I think we heard from the new CMHC CEO this morning that that might be some of the changes that are forthcoming, in the sense that it really isn't affordable to some of the nonprofit wait lists that we're talking to. I mean, I think AISH, the social infrastructure in Alberta, gives you $1,800 or $1,900 a month. And so you can't afford $1,700 when you make $1,800 or $1,900 from.
Yeah, you need a $60,000 a year job to do that, and not that people making $60,000 a year don't struggle with affordability as well. But there's definitely if you're below that, it would be tough. I mean, this might make you laugh. Mark Kenny was on the podcast a while ago, and he argued by the affordable definition that it should be 30% of the renter income defined as affordable. That his most expensive units do feed the affordable prerogative, because the people living in those units make a lot of money. They're spending less than 30% of their income on these very expensive units. So that's his argument, is that he actually does have a lot of affordable units at that level that don't get recognized.
It's all relative.
But they are below the 30% renter. I mean, it is said tongue in cheek, I'm sure, but that was one of the funnier moments of the podcast last year.
He's got a lot of wit.
Yeah,
he is good. How do you source these things, and is there expansion plans?
We'd like for Housing Impact Fund number 2 to be, 2 of 10. We view it to be a multi-decade thesis with, the supply and demand imbalance in Canada. Even with the international migration being turned down a bit, it's still a big problem. I think 71,000 people moved to Calgary last year, and 22,000 units were built. And Calgary was already full. So, we view it to be a long-term thesis. In terms of procuring investment opportunities, that's kind of one of the outcomes that we'd like as part of these speaker series, is to raise awareness around what we're doing, looking for partners, and to deploy the capital. We can add value with construction and development expertise, or we can just be a passive investor into a project that needs capital. And the best projects are ones that have lower risk profiles because of the community partnerships. You've got a municipality throwing in land, or you've got attractive grant pools that make the economics go around. You've got, a community that really needs an outcome. We've got nonprofit partners in Alberta right now that have some national relationships, but, we're really at kind of the early stages of scaling this thesis and raising awareness around what we're doing. So Right now, we've probably got more capital than we do deals, which is unique.
I was just going to say, like,
Yeah.
I feel like it would be easy to raise capital if you've got the right thesis. Finding the deals and manufacturing the deals is probably the harder part.
Yeah, it's tough. It's a lot of the investments that have surfaced with this fund have come from the nonprofit relationships that we've built over the last 5 to 10 years, and having a finite number of long-term partners, I think, can really translate to success. Where you've got, I think, a stigma in the marketplace where nonprofits don't want to partner with the private sector because they think they're going to get taken advantage of. And so if we can raise awareness around, like, well, here's what the city of Edmonton did, and we're in Kelowna or somewhere, and say, like, let's just copy paste what they did. Nobody's going to get in trouble. It's all above board, and we've got an economic return. We're helping you achieve your objectives, and having those discussions openly. And I think taking some of the inspiration from other markets like Europe and the US have a lot of interesting structures where public and private partners can contribute really meaningful solutions to the community and, achieve their objectives. So, I think if we could do, 500 million in development this fund and $1 billion with the next fund, I think that'd be a good outcome for us.
Does the private sector have any track record of taking advantage of the not-for-profits? I don't mean you specifically for the record. Is this fear founded?
Is
at
that
all?
not just because we're seen as sort of capitalists, and so it's eat what you kill kind of vibe, and versus the nonprofits is they're often
here for service.
Right, like they don't have the expertise, they don't have the experience, maybe of working on a volunteer basis, I don't know, right, like it's a totally different environment.
Yeah, and they don't have, development expertise or construction expertise. And, I've seen circumstances, I think it's actually like a public figure. If you've got a public institution that builds a multifamily development project, they will, or a hospital or a school or something, they will pay 20% more than if the private sector did it. I think there's a lot of studies around just, contractors, and, when people know it's a public RFP and it's the big coffers, big balance sheet from the, municipality or the province or something, it just costs more. And the private sector is really ingenious and hardworking and creative, and
profit driven.
I mean, we had a project in the last fund that was getting developed during COVID, and we were self-performing the construction, and we elected to pivot from what would otherwise have been a wood 6-story building. We wanted to do light gauge steel because, as you may remember, lumber, like, I don't know, 3 or 4
skyrocketed.
It was crazy. It was I think my ingenious idea to not fix the lumber, thinking, it's already high, and then it like quadrupled from there, and so that was how good I looked. But we ended up, it was like 3 weeks before construction started, and we pivoted to steel, and it would be difficult for a private sector to move, or a public sector group to move that fast. They probably would have just stomached the wood price. Too bad. Like, that's a change order. But we did a steel non-combustible 6-story building, which set a record, I think, in Edmonton for hard cost per square foot. And, during the course of that project, there was a lot of change orders. There was, global supply chain constraints, and COVID was rampant, and, interest rates tripled. And, there was a lot of circumstances where it would otherwise have been a change order that the private sector said, like, we had a mechanical contractor that went insolvent on us, and we just hired a bunch of mechanical guys and finished the project. So, I think the public sector likes that, and that's what we're trying to communicate to some of these nonprofit and municipal partners. Say, like, let's do it together, and that's the value we can bring.
And I protect your investment.
Yeah,
like that's your response to them.
Yeah, well, for sure. I mean, if we've got a fiduciary to our investors, and we're not going to lose the money. I mean, we've got a really good track record creating attractive returns in difficult circumstances. And I think that's one of the stories we like to tell some of our partners is, like, the rising tide, like, floats all boats, right? But it's only like the best developers and investment management businesses have, strong alpha when times are tough. I mean, and you can solve problems. And I think if you're not vertically integrated now with all the cost inflation, I'd be really worried about the surprises that might, surface during the course of a construction timeline that could be 18, 24 months, right?
I wonder if the long real estate bull run has created a generation of softer real estate professionals because never had their mettle tested in true battle, which is now.
Yeah, that's the Scottish heritage piece that we were just talking about.
Yeah,
the battle.
We're almost out of time, so last sort of line of questioning would be just the apartment market in Alberta. We've been hearing, there's been more noise about rent control, rearing its ugly head. Even in absence of rent control, there's been certainly some rent softening, some vacancy increasing. I mean, you just quoted some statistics where it would suggest anyway that there's more people moving into Calgary in particular than there is units being built. Yet there seems to be some softening of that market just in general. Maybe what are you seeing on the ground, and how do you kind of absorb that?
Yeah, it's interesting. The supply-demand fundamentals are so unique to even a certain region of a city than it would be more broadly into a province. Like, the Beltline in downtown Calgary, we think is undersupplied. The job growth is something that we look at really carefully, and so job growth and population growth translate to rental demand. And if we see tariffs and a slowdown in job growth, I think that could be challenging circumstances for multifamily demand. But what's interesting with these, just echoing what Rob Coomer said this morning in terms of now's a great time to be in the ground. You like with any big project, you're going to bridge an economic cycle and probably some, like political agenda with respect to, a government. So we're trying to, think what the rental market's going to be like 3 or 4 years from now. And I think people are so stuck in like what the news was today. They forget was it 6 or 7 months ago, the Feds put out the report that, Canada needs 3.5 million homes built by 2030. And we're on track to build like maybe, 700,000, maybe 1 million. So it's and I think that 3.5 million was only to meet the G7 per capita units, housing units per capita, let alone exceed it. Like even just to have the similar per capita housing.
It'd still be a tight market even if we hit that.
Well, I don't know. I mean, I'm obviously biased drinking the Kool-Aid, but I think there'll be, in terms of an asset class, multifamily demand has never really been north of 7 or 8% vacancy in, recorded history. Could it be 10 or 15%? Maybe, but we obviously run those sensitivities, and if it's a softer market when we're coming out, I think we've got the the contingencies and the wherewithal to just wait for lease up. If it takes 18 months instead of 8 months, that'd be fine. It'd be interesting to look back at all the disruption that happened over the last 20 years in Calgary, and the amount of reliance we had on the energy space in terms of jobs, and compare what the jobs per industry look like now. It's a lot less reliant on energy, a lot more reliant on, agriculture and clean tech and, a lot of university growth, a lot of healthcare. So the jobs that were lost in the energy space over the years have been regained elsewhere. And we kind of like that Alberta's been out of the limelight. It's funny coming to Toronto. One of the barometers for how well Alberta is how many people attend the Calgary Real Estate Conference. And last fall, it was like chock full of Toronto guys attending, because I think it was hard to deploy multifamily capital in these markets. And so I feel like Alberta's kind of got a sweet spot right now for the foreseeable future. But I've been wrong in the past. So
if you want another vote of confidence, Carl Gomez, chief economist at CoStar, was on earlier today, and he said that all of Canada would be well served if they adopted Alberta as the structure for a multifamily environment. So take that as another certificate of endorsement. Graham, I'm glad we got to do this.
Appreciate it, guys.
Yes. Of course, we want to thank First National for powering the podcast, Canadian Real Estate Forums for hosting us here, and most of all, Graham, thanks for coming in today.
Yeah, thanks. Nice to meet you guys. Appreciate the publicity.
Thanks, Graham.
Good work.
Appreciate it.
It's a tough job you got here.
Yeah. Sometimes.
Yeah.